Small cap stocks just posted their best month in years, up nearly 9% in July alone. But if you're over 55, there are three critical things you need to know before you make any moves. Let's dive in. This week, I want to share what's really driving this small cap rally, why it's happening now, and most importantly, what it means for your retirement portfolio. Plus, I'll share a critical warning that could save you from making costly mistakes in this exciting but volatile market. This week's numbers, let's start with the facts. The Russell 2000 Small Cap Index gained 0.23% this week, which might not sound like much, but here's what's remarkable. Small caps are up nearly 9% for the entire month of July. That's their strongest performance in quite some time. For context, small caps have been the forgotten stepchild of this bull market, but they're finally starting to catch up to their larger counterparts. The real drivers behind this rally, what's causing this surge? Three main factors are at play. First, expectations of Federal Reserve rate cuts in the second half of 2025. This is huge for small caps because they typically carry more floating rate debt than large companies. When rates come down, their borrowing costs decrease, which directly improves their profitability. Second, valuations have become incredibly attractive. Small caps are now trading at about a 55% discount to large caps on a price-to-earnings basis. Smart institutional investors are starting to rotate money from expensive mega-cap stocks into these undervalued smaller companies. Third, we're seeing genuine sector improvements and increased interest in areas of the market that have been overlooked for too long. What this means for retirees. Now, if you're 55 or older, you might be wondering, should I be getting excited about this rally? Here's my honest assessment. This rally represents a real opportunity, but it comes with significant risks that we need to discuss. Small cap volatility remains extremely high. We've seen notable reversals mid-week in speculative names, and individual stocks can still drop 30 to 50% on bad news in a single day. The key is understanding that while this rally is encouraging, it's not a free-for-all. You need protection strategies in place before you consider any small cap investments. Which brings me to something critical I need to share with you. Over my years of helping investors over 55, I've identified 5 specific blind spots that consistently cost smart people thousands of dollars in small cap investments. These aren't obvious mistakes. They're subtle traps that catch even experienced investors off guard. The good news is, once you know what to look for, you can spot these warning signs in about 60 seconds. I've put together a free guide called The 5 Small Cap Blind Spots That Cost Smart Investors Over 55. You'll find the link in the description below. It includes the 60-second detection system that could literally save you thousands. To recap, small caps are having a moment driven by rate cut expectations and attractive valuations. But proceed with wisdom, not excitement. Get the blind spot guide first, then make informed decisions. If this update was helpful, please give it a thumbs up and subscribe for weekly market insights designed specifically for investors like us. Next week, I'll be covering the earnings reports that could make or break this small cap rally. Don't miss it, and remember to grab that free blind spot guide below.